In Montreal, we have Andy on the line. Hi, Andy.
Hello, good afternoon, gentlemen. Thanks for accepting my call.
Sure.
Great show as usual.
Thank you.
Question is for Dave. What is your take on Eli Lilly? Thanks. I'll hang up and listen.
So Andy, sadly as it stands right now, Lilly is one of the laggards in the pharma group. It has really been underperforming. And if a company can't do well from a price perspective in a strong market, I think it becomes a candidate to move on. So you have to know where to draw the line. Stock's just broken virtually all of the moving averages. If you want pharma exposure, I mentioned earlier we prefer J&J. They've got a great pipeline and probably some better growth in front of them. The other way to play it, and I've talked a little bit about ETFs today, we run an ETF portfolio, and you can own the pharma group through an ETF, the PPH. PPH, which gives you a great basket. And if you put PPH up against Lilly, you can see just how much Lilly is underperforming. I'd avoid the stock right now.
So you have a separate fund full of ETFs?
We run a tactically managed basket of ETFs across 5 asset classes. And basically, as opposed to single stock business risk, you are going top down looking for very specific themes. So it's a little lower volatility, a little lower correlation. And I think it's an interesting strategy.
How many in that fund? How many ETFs?
We'd have a basket of about 40 ETFs. 40. And we're very focused right now on equities and very focused on some specific U.S. sectors.
All right, David, we have Lisa in Toronto. She has a question about a company that we know you've held in the past and maybe still do. Here's Lisa. Go ahead.
Hi, thanks for taking my call.
Sure.
Mr. Burrows, my all-time favorite analyst. I'm still calling about American Tower. I've been holding it. It's going nowhere.
Yeah.
And listening to your comments about the interest-sensitive stocks, I believe that maybe American Tower is in the same area. What should they do? I'll hang up and listen.
Great. So Lisa, if you look at the REITs as a whole, are having a very tough time. So you're facing some headwinds from the sector. Actually, American Tower is performing quite well relative to the rest of the REIT space, partly because they have a little bit more growth, a little more economic sensitivity. But that being said, there may be better sectors to be focused in right now. So, I would pose financials as an alternative. If we were to get to a point where the REITs start to turn, I think this would be a leader in the group. But right now, you're just facing a bit of a macro headwind.
And you're out of this one now?
We don't own this currently. Our REIT exposure in our income portfolio a year ago would have been 23 or 24%. Today in the income portfolio, it might be 6%.
Really?
And more focused on industrial REITs. Frankly, we probably should have less than that, but given the time of year, we think that we get a little tailwind into the end of the year.
And just lastly here with American Tower, is this company looked upon differently now that it is a REIT? Because I think it was just the last year it converted.
Yes, certainly people owned it. We owned it for the conversion. And I think that it certainly is looked a little bit more differently. You'll expect to see the payout continue to go up over time. They should have a fairly quickly growing distribution. But it's still tarred with that same brush. It is a REIT as it stands today.
The yield on American Tower right now, 1.5%. Yeah. We got a boatload of questions for David, and we've put a bunch together in the Market Call Minute. Mahid in Calgary called in about Fortis, which made that big $4 billion deal plus buying a U.S. company. Actually, that includes the debt. But I think he was asking about the convertible debentures here.
Yeah, so they're doing an issue to raise money to do this deal. They're selling receipts, which ultimately convert to shares. You put up 30% of the money and you get all of the yield from the underlying shares. When we looked at it, our view was, why are you putting all these bells and whistles on? Should you not be able to sell the shares straight up? So I think that it's a difficult deal to look at because, yes, you're getting a high yield off the top because you're buying a receipt that's giving you like a 12% yield, but really you're levered up 3 times, 3 to 1. So you're taking 3 times the risk to get that 12%. We chose not to participate in the deal.
Alan in Fort McMurray on Cenovus CVE.
We've really avoided most of the companies that are focused in heavy oil and the oil sands. Specifically, we think that if you're going to have energy exposure today, you need to have the low-cost finders with the high revenue, high reserve growth.
Norman, Mississauga on Martin Rea. It's got that lawsuit hanging over it.
Yeah, we prefer to stay away from things that have lawsuits hanging over it. I prefer a Magna or even a Linamar.
Okay, and lastly, Steve in Calgary on good old TransAlta, TA.
Yeah, I just think you have to be a little bit careful in the interest rate sensitive, specifically the interest rate proxies, the utilities, and TransAlta specifically in that camp.
Let's squeeze in one more here. Michael in Toronto, he called in about Microsoft.
Yeah, we like Microsoft. We own it. Some of the big cap technology companies doing particularly well. Microsoft, I think, is becoming a little bit more aggressive, and certainly valuation's attractive.
Okay, very good. We'll take a short pause here and come back with the top picks of David Burrows.